Welcome to Universe's Total Portfolio Podcast. I'm your host, Ron Lagnado. This series covers topics that are relevant to institutional and other professional investors, including asset allocation, portfolio construction, and risk mitigation. We feature leading experts who provide valuable insights that help investors improve performance and achieve their goals. Today, we are pleased to have Dianne Sandoval as our guest. Dianne is currently head of portfolio design at the HESTA Superannuation Fund in Melbourne, Australia. Prior to that, she was head of markets, asset classes, and portfolio strategy at PIF, the public investment fund in Saudi Arabia. She also held senior investment management positions at CalPERS, the largest U.S. public pension fund. In today's podcast, we will hear about Dianne's experience and approach to asset allocation and risk management, with a particular focus on the total portfolio approach. Dianne, it's great to have you on the show.
Thank you, Ron. Fantastic to be here. This is really a topic that I love and am passionate about, so really excited to participate.
Thank you. So before we dive into our main topic, Dianne, just tell us a little bit more about your current position and your previous background in investment management and how you transitioned into institutional investing.
So as you said, I'm the head of portfolio design here at HESTA. HESTA has 1 million members, primarily in the healthcare sector. 80% of our members are women, nurses, midwives, social workers. What I do is essentially design the portfolio that realizes the best outcomes for them. And that includes asset allocation, risk management, tail risk, liquidity risk, product design. A lot of times, though, what I think of myself as is almost the analogy I would use is almost like a nutritionist, and I'll go into that more as to what I mean by that, and really understanding their needs, like what is it that they need to have a secure retirement, when they're done with their working lives and enjoying those retirement years. In terms of my background, I started as an analyst at JP Morgan in 1993 when commercial banks were throwing off the remains of the Glass-Steagall Act and separating commercial investment banking. JP Morgan had this incredible competitive advantage because it was AAA rated and low cost of funding, which was very supportive of investments in private equity, which is where I was working because they had the lowest cost of funding. And I was really working in technology and defense. And then I moved into Mexico City during a period following the 1994 crisis, where Mexico had an ALM challenge. But I was working with the government to build out the local capital markets and pension savings following the Chilean model. And I'm really proud of the work we did because Mexico was a much more resilient position during the 1997 crisis. I then did a startup in innovation in San Francisco. And I only mention this because it really formed my understanding of the importance of innovation and being nimble and able to adopt to change, which I'm going to talk about in this podcast. We sold the company in 2001. I did a stint in private credit. This was, this was right after 9/11 and another crisis as the dot-com bubble unfolded. I was actually working at GE Capital, doing distressed middle market workout loans at that time. Then went to Europe to do an MBA, started working in high yield distressed debt right up until the GFC. When I joined CalPERS in March of 2008, just literally the day that Merrill Lynch and Bear Stearns blew up. And that was my first day at CalPERS, but helped them really build out their high yield internally run portfolio. Then I helped to build the internal private equity research and risk function. And then I worked with you to support the asset allocation and risk function. I then went to the Middle East to basically do the same thing for the Sovereign Wealth Fund of Saudi Arabia. And now I'm in Australia, really helping them with their internalization strategy. So I've been doing this for a long time and have lived through a lot of crises. And I say that because those have really informed how I think about producing the best outcomes for our members.
Well, you certainly have covered a lot of ground in your career, and I imagine that breadth of experience comes in handy now that you're actually doing asset allocation. So let's get to the main topic. Lately, we've been hearing a lot about the term total portfolio approach from pensions and other institutional investors. To me, it appears to be a framework that emphasizes a more dynamic form of capital allocation, opposed to what we generally refer to as strategic asset allocation. But it's not always clear, when I hear people talk about it. So Dianne, to start, how would you define total portfolio approach, and what do you think distinguishes it from SAA, or what we call traditional asset allocation?
Well, you're absolutely right, Ron. I would say there's really three things that I think distinguish it. And the first one is how we make decisions and how we define success. So the first thing with TPA is that our measures of success are multifaceted and goal oriented, and it is more dynamic. But really, it starts with our investment objectives are really transparent and sure that our preferences are revealed and prioritized, and it's at the center of everything we do. So it's not, we just don't do a rigid optimization, which simply maximizes return per unit of risk, but it's a really holistic, multi-lensed understanding of the opportunities and risk, and a very deliberate cultivation of our unique competitive advantages. And then the second key difference between SAA and TPA is exactly what you said. It's more dynamic. So it's a holistic investment framework where all investments compete for capital to maximize the probability of meeting these investment objectives. When I say that we compete for capital, we really are trying to maximize the probability of meeting investment objectives. In contrast, when you're allocating through a strict SAA approach by asset class, you can't really be sure that the next dollar you invest is going to be the most attractive or the most important place to meet the option level objectives. And that's because in a more siloed asset class or strategy perspective, it focuses on beating its own benchmark as opposed to doing what's right for member outcomes. So you're potentially leading to over diversification at the overall portfolio level, because if every asset class is building in diversification within its own asset class, and you see that happen often, then you might be leaving money on the table. And that's because the person overseeing that asset class is mostly focused on the impact of the investment on a standalone basis, as opposed to how that really comes to bear for member outcomes. So it's really acting as one fund in a more integrated mindset, ensuring that decisions are made with the members' investment objectives, at the center of every decision. And then it's also about how we share information and prioritize research ideas and create innovation. And that's really leveraging the diversified team across asset classes, markets, and partnerships to really access and digest information and ideas and turn it into insights for total portfolio processing. How do you cultivate so one of the best books I've read on forecasting is from Super Forecasting, which is the art of science in decision making. And they talk about how you cultivate inside and outside views, which effectively balances assessing how often similar events have happened in the past, or the probability of the event happening, which is a Bayesian outside view, with the specific and unique details of the current situation, which is the inside view. So how do you bring these different views to bear is also part of the secret sauce, I would say, of TPA, that I think leads to greater innovation and greater resiliency for how to navigate uncertainty and make important decisions in light of a lot of uncertainty.
Yeah, so it sounds like it combines a lot of elements of, I think, what has always been the case for other forms of investment management, like active management, let's say a bond fund, which I did years ago. Anytime someone proposed a new trade or new strategy, you had to look at it in the total portfolio context. In other words, what would be the marginal improvement to return and risk by introducing this strategy or trade? You didn't look at it on a standalone basis versus similar trades. So for example, a very simplistic example is if a pension fund such as you has an infrastructure allocation, real estate, and you want to buy a building, you're not just considering how that fits into the real estate portfolio. You want to know, how does adding that investment impact the overall portfolio? Would you say that's a correct assessment?
That's absolutely right. That is the opportunity, because that investment, and it might be, they might come to us in the decision-making committee and say to us, we want whatever, 100 million invested in this infrastructure or real estate deal. And the reality is we might want 3 to 4 times that from a total fund perspective. But if they're assessing it only from the risk perspective of their, individual portfolio, that might feel uncomfortable for them and will feel uncomfortable for them. And that's why you really are navigating those agency issues, right? So that we're really, and you're essentially eliminating them. You're saying, no, you're not going to be incentivized on your individual performance. You're going to be incentivized on the total fund outcomes. Now, that's both an opportunity, but it's also a challenge, and it's a disadvantage in that, that's not how the traditional asset management world has been structured. In fact, it's been structured completely the opposite. It's been structured on a relative to benchmark basis and on a standalone basis, and just measure my individual performance as opposed to member outcomes. And so that really is, from a cultural perspective, the challenge. And every time we bring people that haven't been part of this TPA mindset or journey into the organization, there's a lot of work that you need to do to be really clear as to how this is different. And we have to be honest. I mean, you do need to get that incentive structure right to ensure that, they do feel like they have some skin in the game for their own particular, contribution and outcomes. But ultimately, they're still rewarded on the total fund basis. And that's not an easy thing to navigate. So that really is, if you were to ask me what's the biggest disadvantage of TPA, is the governance model is more complicated, and maintaining that culture is more difficult than it is in a let's say traditional SAA approach.
So one point of confusion for people I find is that, how do you actually, what distinguishes TPA from strategic asset allocation in terms of how do you decide how much to allocate? In the end, you still have to make a decision, right? How much public equity we have, how much fixed income, how much alternatives. In strategic asset allocation, it seems like we rely on optimization. We look at capital market assumptions. We have some end objective in terms of what our return target is. And from there, looking at historical parameters, returns, volatilities, correlations, we decide initially how much to start our investment. How do you go about it in a total portfolio approach? How do you actually use some form of optimization to construct the portfolio?
Yeah, look, absolutely. I would say that TPA is often called SAA every day, which it kind of is. And so, capital market assumptions are just one tool in your toolkit. And what they're trying to do is help you to make decisions faster and easier, but then understanding what are the limitations of those models. And so what other models or tools can you use to supplement making those decisions faster? I think it is really important to have a systematic process. So when I think about resiliency and how we make decisions in a more nimble way, there's many layers to that. One is, yes, we use traditional tools like optimization, but it's not just the use of the tools, it's the understanding of the tools and where are their limitations and what are they good at and what are they not so good at. And then how do you complement that with simulations or risk management tools and stress testing scenarios, or we've built these incredible simulators that allow us to really change, different variables, everything from a correlation assumption to a return assumption, so that we just understand. And then based on I also manage a team of economists. Based on our economists, our experts, best understanding of probable outcomes, how do we then position our portfolio to align with our best thinking on what will result in maximizing investment objectives? But it does really start with investment objectives. We do a lot of work there on being really clear with our board as to how do we define success. And we actually have a presentation again coming up this month in April, not this month, in April, the month is already ended, where we're going to have that conversation again. And it's a really important conversation to be really clear on in terms of how are we measuring success? What does success look like for us that is unique to us? And I talked a little bit about being a nutritionalist. And the reason I say that is because it does matter what your client's starting health needs are and goals are. And so you really have to think of it that way. So let me just give you an example. In Saudi Arabia, right? They had really clear objectives that they wanted to achieve. But their position in the world was that they were the lowest cost producer of oil globally, right? And they were essentially really long inflation. I didn't need to build inflation protection for their portfolios. Whereas, at CalPERS, when we both worked there, right, inflation mattered because it could hit your assets, especially if you have a big exposure to California technology assets, and those are longer duration assets, and because you have cost of living adjustments in your pension benefits, right? So your assets get hit, your liabilities get hit, you're short inflation. So that it's the same way as you would look at, a nutritionist would look at, what is your unique physical and health conditions, unique to you, that I need to take into consideration when I build those beta exposures, and that, I don't know, North Star of what that risk and return dimensions should look like, and not just risk and return, but what are the factors in whether it's inflation or growth, or how important are they to you given who you are. And so I always start with that, and have a real conversation. So we do a lot of studies with our members on who they are and what success looks like and means for them. And that's why I say, you have to think of yourself almost as like a nutritionist, and then make sure that you build out not just the right diet, but you understand their preferences. So you understand when are they going to be at their most vulnerable and most feel like they want to cheat on that diet, and so how do you support them to make the best decisions in those moments? And how do you build the processes and tools to get there and to really have, the healthiest client, that you possibly can have at the end of that nutritional journey. So that's how I think of it.
I think there's two important subtopics that I want to get to, in our remaining time. So one is the dynamic aspect of TPA, in contrast to strategic asset allocation, in terms of what guides you in your decisions to adjust allocations. And the second, that's very important, certainly to us at Universa, is risk mitigation. How do you view risk mitigation in the context of total portfolio management? So in terms of the dynamic approach, so it's said that, for example, in TPA, you really have more of an eye on factor exposure as opposed to asset class exposure. So how do you dissect your portfolio in terms of factor exposure? Is that the way you approach it? Do you want to look and see how balanced you are across factors as opposed to asset classes?
I think that there's so many different ways you can think about that problem, and I think having a diversity of perspectives allows you to get there faster. So I think I mentioned that we use optimizers, we use simulators, but we also use our factor lens, but we're also thinking of building out kind of a cost of capital concept as well, because you really also, like any one of these tools, can capture one dynamic of your investment objectives, right? So you want to maximize return per unit of risk. That's what your optimizer lets you have a lens on, but then it assumes that all of your CMAs are correct, right? And there's a lot of estimation error in private equity models and even in public equity models, and certainly in commodity models, right? So there's a weakness there. That's why you have simulators that kind of let you assess and understand, where those weaknesses and assumptions can go wrong, and how you think about that and address that with better diversification and true diversification in your strategies. We also look at, like I said, like illiquidity. Are we actually getting paid for that illiquidity premium? And that's where this whole concept of cost of capital comes in. You are giving away the right to be nimble and manage that risk when you take a private investment for the next 10 to 12 years. And so how do you actually compare that to a liquid public equity investment today? Well, you need another tool to do that, right? And so, again, we have different tools that allow us to really think about how do we use the different levers of alpha that we have. And some of those levers are active management, right? Some of those levers are, and so making sure that we, have fantastic people that are really developing our signals and our processes for where we deliver alpha and how we deliver alpha properly. But then we also have this whole illiquidity premium that we want to get right. And then we have liquidity. Like, how do we manage liquidity and our access to liquidity? Because, a lot of pension funds talk about, how they have a competitive advantage in being long-term investors, that's only true if you actually can survive the short term, right? And if you actually have a plan in place that gets you through that. And so going to your second question of risk mitigation, and look, we're constantly innovating and upgrading this, but we have a very detailed and deep understanding of resiliency. So, part of that is, do we really have liquidity? Do we really understand our liquidity? And in that, and I think if you imagine what gets people in trouble is, let's say you have a fire, and the fires don't happen that often. But when they happen, are you in discovery phase? Are you figuring out, like, where are the exits? Are you figuring out who's calling the fire department? Are you figuring out, are you in discovery phase? And therefore you're not really prepared. And we know that the human condition is one where you are making your least rational decisions in moment of stress. Right. So you don't want to set yourselves up to do that. You don't want to be in discovery phase. So we have playbooks around our liquidity, and we have real clarity as to what is that waterfall, and how quickly do we need to, like, if a member says they want to pool their money, there is a legal requirement for how quickly we need to do that, right? So do we have all of those waterfall and legal requirements clearly understood in the organization as to how quickly we would need to convert to cash, and what our lowest cost of funding would be to make the best decisions in that moment? But also, the first understanding is plan, right? Do we have a plan in place? And do we really know how we're going to act, and what's the playbook during a crisis? The second is, so that's first to funds. The second is, do we actually have diversification, true diversification in our diversifiers, right? So bonds are great diversifiers for an equity sell-off if you don't have an inflation surprise, right? That was 2022 when you had an inflationary surprise, and then your bonds are no longer your diversifiers either. And so, like, do we really understand diversification for us and what matters for us? And so really thinking through how we diversify our diversifiers under different kind of economic regimes. And then the fourth thing is, just quite frankly, we making sure we have the toolkit to really do that. So we can use derivatives. We have an overlay and a team that can use options and derivatives, and we do manage this internally. And to be honest, it's really an area where we're constantly innovating, because the marketplace is demanding it. And so that last piece is, I talked about innovation and how I did that in a startup, and how that's really influenced the way that I think about building resiliency. It really is about getting the right group of people together, and that knows how to make decisions under stress, and have have done that with playbooks, and have done that in a consistent way, and then get better at it over time. And so part of that for me is even how I build a team. So I have this idea, I literally call it the idea, IDEA, and in order for an idea to be at its most success, I have imaginers, that's the I have developers, those are my engineers. I have evaluators. Those are the risk people, the naysayers that say, did you think of this? Did you think of that? Did you think of this? And then I have the actors. Those are the people that commercialize it and make it happen and make sure it's actually profitable when we go to execute. And when I build a team to solve any problem, and particularly if we're in a crisis, I make sure that I've built that idea team, and there's a diversity of skill sets there that help innovate and make that problem easier to solve. So it's also just even in how and what teams you put together. There's a cultural aspect to it, as well as a process oriented, as well as just giving them access to the right tools, so they can have enough tools in their toolkit to actually make the best decision for our members.
But focusing more on risk mitigation, so how do you view tail risk? In what sense do you try to protect yourself against extreme outcomes like we saw during the global financial crisis, or the COVID pandemic? Do you have any special provisions for that? And in terms of tail risk, what is the dominant source? Is it equity risk, currency, interest rate? Do you have approaches for all of those?
Yes, absolutely. So I would say the biggest risks for us are equity, currency, and inflation. Those are the top three. And when I think of the potential impact on long-term performance, I think of a fantastic quote by Albert Einstein, who talks about how compound interest is the eighth wonder of the world, and he who understands it earns it, and he who doesn't pays it. I think that that's why we talk about diversification. That's why we talk about mitigating drawdowns, because if we can mitigate the drawdown, especially if it's a long-term drawdown, like what we saw in GFC, then we can continue to earn that compound interest faster and better over time for real return outcomes for our members. And I should start with saying that one of our objectives, investment objectives, is a real return outcome of CPI plus 3%. It starts with that. So if we know that our objective is CPI plus 3%, and another objective we have is, and these objectives sometimes do conflict with each other, but we also have prioritizations of them. So we do have one objective of maximizing real returns. We have another objective of minimizing drawdowns, which is related to the first. We have another one of managing peer risk, because we're in a very competitive marketplace. And so we always want to be in our top quartile. So that's part of how I need to eliminate any agency conflicts of interest, so that I can, have the best chance of beating our peers. And then there's a regulatory one as well in Australia. There is a Your Future, Your Super benchmark. And so in order to maintain your social license, the regulators force you to, over a 10-year horizon, beat a benchmark that they have set. And if you do not beat it, you will have to write a letter to your members and say, we have not met our Your Future, Your Super requirement. And so you first have to write a letter, which is not great, let's say, and a lot of that would probably already cause half your members to leave. But then by the second year, if you have 2 years failing, they actually stop you from taking new members, and they will essentially shut you down. So that's another objective, is that we just always maintain that social license. So it's like it's a regulatory objective.
Yeah, I think that's sort of in stark contrast to the way pension funds operate in the U.S. So you have the sort of competitive environment that has to kind of keep you on your toes. You have to, you're held accountable for poor performance, which is, I think, a great thing. But, back to equity tail risk specifically. So imagine you're going through, I know you weren't there during the COVID pandemic, March of 2020, equities are down, let's say 30%, at the worst point. You mentioned your diversification is sort of a first line of defense. So now bonds in the portfolio have rallied. So what do you do at that point? I mean, what's the dynamic aspect of what you do in that situation? Do you rebalance? What would you base that decision on? What do you expect to get out of that, for example? Or do you just ride out the drawdown?
I think the advantage of a systematic process is it allows you to make decisions faster. And I think I mentioned earlier, I think the biggest source of alpha for a long-term pension fund is avoiding behavioral biases, because we're at our least rational either when the market is falling quickly or when we're greedy, fearful or greedy. I think that's why we have this SAA every day, to really look at, well, do we have enough liquidity? If this crisis was to last a month, a year, 3 years, like, well, how do we navigate that? And then, how do we optimize that use of liquidity in that moment? So, that's why you would go straight into, we understand our use of, we know how much liquidity we have. We know how we can essentially put on call options. For example, we can maximize our capital efficiency and our balance sheets in those moments, so that we don't necessarily use all our liquidity in one day. But yes, we start to gradually essentially add risk during those moments based on our assessment of how long will this crisis last, how much liquidity do we have, and do we want to use all of are we convicted to how convicted are we? And there is a, so the way we think about adding risk in those moments is our probabilities of, we do believe that markets are mean reverting. So our conviction, as equities fall 50% versus 20%, our conviction really grows. And so our ability and our desire to lean in would actually grow. And so that we have a pretty systematic approach and pretty systematic signals that would guide our decision and help us make those decisions easier.
So does rebalancing play a role in the TPA in the same way, I should say, as it does in strategic allocation, where you have this strict adherence to these targets, target allocations, which really don't change, over, a relatively long period of time. How does rebalancing play a role in the context of TPA?
Rebalancing is a fantastic tool to like during your everyday normal environments, and the way we do rebalancing is trigger based. It's, so it's based on how much the market has moved, and given the relative risk that we want to maintain and our conviction in maintaining that, it's almost automated. I have a team that monitors those signals, and then, in the morning that we come in and we say a signal's been hit, are we rebalancing? And, under normal conditions, it's always yes, just rebalance, maintain the risk, etc. When we hit a crisis, then it becomes that's why the playbook is slightly different. Then it becomes, do we have liquidity draws, and what's the priority of those draws? And because we need to maintain, our social license. Like, if members want to withdraw their money, we have to come up with that cash. How do we navigate those trade-offs in the most efficient way to maximize outcomes for our members? And so that it does become a slightly different discussion in the moment. So it depends. So we don't automatically rebalance. Let's say in that moment, we would really think through, how do we rebalance? And that's why I'm saying we have playbooks. How do we ensure that we are meeting the highest priority needs, the legal requirements first, and then doing our best for members? And what instruments do we have to really access the markets and maintain our risk exposures in the most efficient manner?
So we're about running out of time here. So just this is the final thing I'd like to discuss. So you mentioned, in the context of tail risk, that you do have internal programs that address tail risk. Some of them may be, in fact, option or derivative based. But, in under traditional asset allocation at pensions, things like tail risk protection are sort of viewed as a cost. In other words, it's seen as sort of this line item cost, not viewed in the total portfolio context. So in your approach, where you do incorporate tail risk protection, how do you view it? As a cost, or how do you look at it as basically, from the overall portfolio context? So there isn't this sense of, we need to cut this out because it's costing us too much, in a rising market.
I don't look at any type of strategy with that inherent bias, is what I would say. So every strategy has a role in the portfolio and has a benefit to play. And it's just about, are you maximizing the benefit you can get from that type of strategy? If you're not, I think the reason that the tail risk strategies have not worked well for some investors is, when the fire comes, they don't actually call the fire insurance. They don't actually use it. And so, yeah, that would be pretty expensive if you haven't put your processes in place to actually use it when you need it. And so I think it's really just about structuring your process so that you're able to make decisions more nimbly and more rationally to optimize member outcomes. And I think a lot of times, again, because you have, we do a lot of forecasting, but actually the value we bring is in the planning, right? And that's kind of what I was trying to say, is I do a lot of planning. Yes, we do forecasting, and we try and build a number of tools to get, the best insights we can on our forecast, but we have plans and we have playbooks. And we know how these instruments will behave so that, we can make better decisions in the moment that really are focused with the member at the center of that decision, the outcomes to our members, not the outcomes to, someone's individual P&L. It's just a different approach.
Well, Dianne, this has been an extremely interesting conversation. It's really helped me sort of get a better understanding of what total portfolio approach is, as it's sort of currently being considered in pensions and other institutional investment organizations. So we certainly appreciate your giving us your time and sharing your insight, and hope to have you on the show again at some point.
Thank you, Ron. Fantastic being here. Take care.